whether it's 300 billion, the amount forecast by the Office of Budgetary Responsibility, or 330 billion, the amount forecast by the Financial Times, it's quite a lot of money, and it's the difference between, this is what I'm talking about, it's the difference between what the government is going to and is spending largely on COVID-related support and other stuff to run the country, and what the government gets in. It's the public sector net borrowing requirements. So the question that arises from that, and it is arising more frequently, is where does the government get the money from? Less asked, more asked is the question, how's it going to be repaid, and what does that, or what might that mean for me? So just the first bit, where does the government get the money from? They get it from the markets by issuing gilt-edged securities. Basically, they borrow money. The biggest purchasers of these gilt-edged securities are, according to latest stats, and this won't surprise you, pension funds, life insurance companies, who need to have a source of money flow guaranteed to enable them to fulfill their commitments to pay out annuities and other regular payments. The Bank of England are clearly a big buyer, and also foreign investors, sovereign wealth funds in particular. So they're the people that give the government the money. The government borrows that money from them for a period of whatever, as long a period as possible, you'd expect now, with such large amounts being borrowed. And interestingly, at very, very low interest rates. In fact, just recently, we are hearing of negative yields on government bonds. What does that mean? It means that the total of the interest that you get and the money that you get back at the end of the period, because the government does have to repay it, is actually less than you gave them in the first place, but you're paying for the security, or maybe the ability to sell that investment if things are even worse, to make a profit. So basically, that's where the government largely gets their money from selling gilts, basically borrowing money from the market, which of course has to be repaid. And so we've got a constant flow of needs to be repaid for the various bonds that have been issued in the past, and this much bigger need for the borrowing that's going on now in the future, and that's where the 330 billion comes from. So what could that mean in terms of the ability to repay that? Because that difference between what the government is getting and what it's paying out is much bigger than it was predicted to be at the time of the budget on the 11th of March, which seems ages ago now, when a fairly substantial programme of infrastructure spending and spending on public services led us to a 50 billion gap, but that's gone up to 330 billion or 300 billion, depending on which forecast you believe. So how's that going to be repaid? Well, like any debt, you think, well, ideally it will be serviced out of income. So basically the money that you get and any savings that you can make. So when it comes to savings, i.e. spending less, the government seems pretty committed to not adopting a strategy of austerity, as we did post the financial crisis. So austerity seems to be off the table. Reducing significantly public expenditure seems to be off the table. So how are we going to get enough money coming in? Well, that's what leads to the questions over what that means for taxation, and will it mean tax increases? So let's have a think about that. The biggest generator of tax money for the revenue in the UK are these three taxes: income tax, national insurance and VAT. And unfortunately, the government gave a promise in the lead up to the election that there wouldn't be any increases to the rates of those three taxes. I'll call national insurance a tax for this purpose. One would probably be, they'd probably be forgiven. One would forgive them for saying, actually, we can't stick with that promise because of the unprecedented times. But how much would increases in these taxes yield? 1p on any of those rates would yield between those taxes would yield between 4 and 6 billion pounds. So meaningful, but not in the context of 300 billion. It's also interesting to know how much more you need to add to the higher and additional rates of tax to match a 1p increase to just the basic rate of income tax. You'd have to add over 4p to higher rate tax and over 28p to additional rate tax. And of course, increasing those taxes also has a diminishing effect on demand and expenditure. And one of the main ways, of course, to get more money in, apart from increasing the rate, is to increase economic activity and generate more tax being paid. So that's, there are a number of factors behind the tax yield. Of course, the rate is one of them, which we'll come back to in a second, but there's also the amount of activity, the number of individuals and institutions actually paying tax, the cost of collection, and the degree of compliance, i.e. the lack of avoidance, hopefully, and evasion. All of those things play together to increase the tax yield. So going back to this point of tax increases, because that's what people are concerned about, how about corporation taxes and big companies out there? Well, corporation tax yields over 50 billion, but not that much more than 50 billion currently. And we need to remain attractive as a company, as a place, a country to do business, especially because we have Brexit, of course. That has been done, Brexit and then Brexit. And that seems to have been forgotten a little, and the impact that may have, probably negative, at least in the short to medium term, on the economy. So making the country an attractive place to do business is important. So increasing the corporation tax wouldn't do a whole lot, wouldn't do a whole lot for that. We've already seen the ditching of the proposed reduction to 17%, and we're staying at 19%. And there's capital taxes. There's been talk over a number of years of changing the way capital gains are taxed, maybe taxing capital gains as income, thereby increasing the rate payable, but there's nowhere near as much capital gains tax paid as there is income tax, national insurance. So the impact of that on its own perhaps wouldn't be that huge. There's a number of other factors to consider before that sort of change is made. And then there's inheritance tax. We all talk a lot about inheritance tax. There's been, in the sector anyway, there's been an awful lot of talk and some proposals, notably by the Office of Tax Simplification and the All-Party Parliamentary Group for Intergenerational and Inheritance Fairness. They put forward a range of proposals for changing inheritance tax, and some of them, particularly the OTX proposals, are likely to be adopted. When you consider inheritance tax only yields, well, not only, I mean, it yields between 5 and 6 billion currently, even doubling the yield from that gets you to just over 10. So, you know, yeah, changes probably will be made. They are probably overdue, but they're not going to have a whole massive impact on the debt. So what else could help us towards any kind of change? Well, maybe some new taxes. You know, if we're looking at expanding the tax base, ensuring enough people pay the tax, increasing the rates, how about some new taxes? There's been talk of a windfall tax on some companies that have done well out of this lockdown. Notably, obvious one for us always goes, supermarkets, there was hoarding, there's people buying stuff because they in supermarkets because they can't buy it anywhere else. Haven't they done well? Well, the supermarkets are saying, yeah, but we've had to spend loads more with new processes to comply with social distancing, to keep our staff safe, and all of that. And the same for online retailers, so they say. So not sure how much that will yield or whether there will be resistance to it. The other tax is some form of wealth tax or one-off kind of solidarity tax, or even a continuing tax that says we need this money for good causes, which many of you have benefited from. So how about a wealth tax? The FT quoted recently that if, and this wouldn't happen in this way, but if you applied a 2% one-off wealth tax to the entirety of UK personal wealth, including your main residence net of mortgage and all your savings and your pensions and all, if you applied 2% to that, then you'd get just over 300 billion pounds. Job done. Except that it's easier said than done. Of course, there's the issue of liquidity, raising the money, fairness, valuation, because that would include actually small businesses as well, the value of an interest in a small business. So a lot of practical difficulties, apart from philosophical difficulties, given that we have a conservative government. So there's a range of things that could be considered, even if we left the more outlandish ones possibly to one side. I think we could probably expect to see some element of tax increases over the coming years. I think those decisions won't be made until it's clearer, until the Chancellor is clearer on the shape of the recovery. Most people are now saying it probably won't be V-shaped, more U, all the rest, not immediate, more gradual, and that will have an impact on the type of measures that the Chancellor will feel he needs to introduce. I mean, undoubtedly, and we have a budget set for this autumn, but whether any significant changes are made at that point, because it might not be clear enough at that point, we'll have to wait and see. So basically, it's going to be a combined approach. I can't imagine that there's going to be there's not a silver bullet, one thing, leaving aside that wealth tax idea. It's going to just going to solve the problem or arrange for the debt to be repaid simply. There's also the very important factor of the role that inflation can have over time on the real value of the debt, and the ability for inflation to eat away at the debt to make it more manageable. That's happened on a number of occasions in the past, so historically. But at the moment, we're looking at pretty much close to zero inflation, and no great prediction for it to increase massively, but we are talking relatively long terms here. And then, of course, there's the all-important factor of just getting the economy going, getting it running and working and generating money for businesses and generating tax for HMRC, which has to be the thing that is going to have the biggest impact, just reigniting the economy and generating activity, money flow and taxation. So basically it's a combination approach. It's definitely a watch this space approach, probably not in the immediate future for tax increases. Maybe a little clearer when the next budget comes, depends on how much clarity the Chancellor has on the shape of the economic recovery. Hope you found all of that useful. There are some detailed Techlink bulletins on that, two in particular, which I would encourage you to go and have a look at to get a little more information.